manly men, 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 manly men, men, men.
Men, 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 manly men. Woo-hoo-hoo.
Men, 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 manly men, 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 manly men, men, men.
Hello everyone! First we are going to give you a quick preview of the background of our hotel. The Epicurian Hotel is 8 years old and is a full-service 3-star hotel ideally located in the city center. It has 250 guest rooms, 200 standard and 50 premium, a restaurant with a bar lounge section, conference room and a small swimming pool. Our target market are leisure people, as the hotel is in the city center by waterfront side, and business travelers due to our large range of equipment and facilities. We want to differentiate ourselves through value-based strategy, offering higher quality service than our competitors.
Our pricing policy is realistic, dynamic, and aiming at optimizing revenue. We want our prices to reflect the service offered at our hotel, considering global demand and competition. Our pricing strategy is an undercut strategy, which means we will be just below the competitive set. Furthermore, we want to make sure our prices are coherent. Incoherence in price differences can affect guest perception of value of what they are receiving and could create unsatisfied guests. Our pricing model is a shrinking model which will allow us to develop rates individually.
Now we are going to take a deep look at our performance over the last 12 months, presenting you our analysis and findings. And finally, we are going to conclude by giving our recommendations for the future.
In the first quarter, the relocation of new corporate headquarters into the area are expected to impact our business and corporate demands. Also, an increase in requests for proposals for long-term occupancies. This is also due to the developing regional hospital nearby, which is expected to double in size and service this year. For price setting, it is important to take into account three main things: the customer, the accountant, and the competition. Therefore, for this first quarter, we wanted to use a markup pricing method, which means we wanted to cover our costs as we did not know the rates of our competition. We also wanted to see how our customers would perceive the price given the value of our offer. In order to save on distribution fees, and based on a strong demand from the transient segment, we made direct booking prices for this segment more attractive and decided to focus on this segment and channel particularly. As Cindy Estes Green explains, it's better to favor direct channels to avoid extra costs and therefore increase profit.
For the marketing and advertisement department, our guideline was to limit at around 7% of marketing expenses in function of our revenue privileging the direct booking, like we can see in this graph.
We have received the first request for proposal in March. We had low occupancy indexes and was a low season period. Certainly, for the first proposal, we had some difficulties in decision making and calculations. But in the end, we came to the conclusion that for the bid price of $139, it would be interesting for us to accept the group.
In terms of refurbishment, we wanted to start strong in the market and differentiate from competitors by having outstanding quality. Therefore, all biggest investments possible due to the available funds were applied. Guest rooms premiums, public areas, front desk, and the lobby. These being the most visual and first impressions of our customers, we emphasize on our funds to maximize guest satisfaction. Also, cleaning contracts were applied, but even though we clearly beat our competitors, this was soon realized to be a mistake from our side, because cleaning contracts cannot be used more than 3 times throughout the entire year. Facility-wise, we added the most important functions at the beginning, including internet access, especially for business target, currency exchange for all international travelers, minibar, express check-in and check-out. All these changes were applied in order to improve customer service satisfaction, which clearly was too low.
At the end of the first quarter, our results are encouraging. Indeed, our route efficiency is 90.3%. Moreover, our occupancy rate is 1% below the competition, but consequently compensated thanks to an ADR and revenue per room available clearly above the competition. We can therefore assume that we gain more revenue and profit.
This new quarter announced a continuing demand for small groups of less than 15 rooms for family and social events, especially on weekends. There is a new civic center opening at the end of the quarter, which will promote potential demand, and it will be the occasion for the Epicurian to stand out their room offers to maximize revenue.
The prices we were offering in Q1 were too low compared to the competition, and compared to the value we were offering to our guests. Therefore, this quarter we decided to raise our rates, and we thought that guests would be willing to pay more for the value of our offer. For the same reason, we also decided to change our pricing strategy to a matching position. As demand for transient segment was higher on weekends, we associated our rates based on trigger points to make transients stay longer during the week using discounted prices to attract them. The same way we wanted to encourage and focus on certain segments and channels, we also wanted to discourage others, such as wholesales and groups, by putting higher rates.
For the marketing and advertisement department, our guideline was to limit at around 7% of our marketing expenses in function of our revenue, privileging the direct booking. For the first quarter, we can see for the month of Jan that our marketing expenses is above 30% of the revenue. This is an error of our part since we interpreted the revenue for the quarter as the monthly revenue.
Our second request for proposal was in May for 2,800 room nights during the weekdays. We had average occupancy indexes, but was not yet a high season period. We improved our calculations and we saw that it's hard to put low prices and we would have to displace the transient guests. We believed that the group would compensate the loss of those who had to walk, and therefore we came to the conclusion to put $170 as a bid price.
The idea was to continue investing money between refurbishments and facilities. Cleaning contracts were continuously applied for premium and standard rooms to keep it up at a high score of hygiene. $80,000 investments was applied overall in Q2 for soft goods redo, especially in the lobby, but also for the parking groups and pools as they generate revenue and are highly used by our customers. In the middle of Q2, we were clearly the highest quality of all marketplace. But at the end of May, to be precise, it is where our cleaning contracts issue started, as we had been too performant at the beginning of the year. In June, most of our funds went into front desk renovation, providing 100% facility rating and registered in the capital additions line on the balance sheet.
Our room occupancy in June is 72.4%. This performance is above the competition with a room market share of 14.5%. Our market penetration is higher than the competition. We therefore can assume that we won market shares. Moreover, our gross operating profit has reached 36.44%, which clearly proved that our strategy on focusing on direct booking rather than distribution channels was successful.
After successfully completing Q2 with our business on the rise, the third quarter announced itself more challenging. Although the general economic condition improves and a high season, the Epicurians struggled in keeping up optimization.
In order to stay loyal to our positioning, we decided to increase all our prices to stay coherent with the competitors and to adjust to the high season. Although we increased all our prices, we wanted to keep them moderated by using price reductions should bookings be inferior to 55%. According to 3 Hanks Cross Noland, hotels need to discount to satisfy as many guests as possible and maximize revenues from existing demand. During this quarter, we looked at the progression of rooms sold between the quarters by segments and channel. We kept a strong focus on direct bookings because that is where we get the most profit. Our strategy to attract more transients through direct bookings as well as to discourage wholesalers and OTAs through high rates stays consistent during this quarter.
For the second quarter, we decreased our marketing expenses with the goal to reach the guideline given to us to end at around 6%.
In July, we have received another request for proposal for 2,400 room nights during the weekends. We have corrected our calculation methods, but we were quite confused with the information provided, as at that time we had good occupancy during the weekends and in addition it was a high season period. We did not want this RFP and our conclusion was to put $180 as a bid price.
During Q3, the overall quality of our refurbishment decreased tremendously compared to the previous 2 quarters. This happened because our budget was too low to renew soft goods and cleaning contracts ran out. Nonetheless, we can see on the refurbishment levels that we remained very high for the front desk due to its fresh renovation, and overall we remained more or less in the same average standards as the competitive set. Our facilities, on the other hand, were increased and the guest satisfaction reached its highest point of the year with 40%. This was achieved by focusing funds on restaurants and conference rooms.
The results from the third quarter are mixed. Our ROE dropped to 0.58%. Excess of marketing investment can be responsible for it. Despite the high season, we lost market share during July, mainly due to the group we decided not to attract. However, we increased our RevPAR and ADR in July thanks to our strong focus on direct booking. Moreover, in August, we reached our maximum profit to 267,000 before dropping down to 146,000 in September, signaling the end of high season.
Unfortunately for the Epicurian, Q3 decreased its revenue optimization. Entering now the last quarter, it will be one of our biggest challenging periods. The hotel is expected to change strategy and attract customers, especially since high season ended.
For this final quarter, as we are going back to mid-season, we decided to decrease all room rates by 10%. However, the competition decreased their prices considerably more and therefore captured part of our market share. We found it very difficult throughout the quarter to gain this part of market share back.
For the fourth quarter, we reached our goal of 6% of marketing expenses. However, we noticed that the positive feedback stopped when reaching our goal and our revenue dropped significantly.
We have received another request for proposal in November for 1,600 room nights during the weekdays. The high season period ended and our occupancy started to decrease, but the cost remained high due to some successful investments during the previous month. After in-depth analysis and rigorous calculations, we have concluded that our bid price is supposed to be $109.
Throughout the last 3 months of the year, facilities remained untouched because of the lack of available funds. Some refurbishment soft goods redo were applied for the front desk, the bar lounge, parking, and environmental programs, as they were the cheapest options. The levels remained average, except for the restaurant, which was renovated too late to be caught up. In terms of guest satisfaction, we maintained the facilities and services, but rooms and public spaces reached their lowest points.
For this quarter, our overall performance decreases. This comes mainly from our facilities and refurbishments departments. They couldn't invest anymore due to funds limitation. Therefore, the quality customers were expecting dropped. As a consequence, our occupancy fell to 58% and our RevPAR dropped under the competition average.
For the months to come, we would recommend to use the profit made during the last quarter to renovate the guest room for both standard and premium category. The cost for those renovations would be over $2 million, which is roughly 50% of our total profit made during the year. It would improve the value perception of our hotel that was failing the last 2 quarters, and therefore improving guest satisfaction, and would generate good comments on social media, surely justifying our prices and increasing our market shares in the short to mid-term.
When it comes to the long-run recommendations, we would suggest to continue improving the quality of service and to invest more in refurbishment. Also, in the long-term future, we would suggest to stabilize market indexes and to focus more on visible trends, such as seasonal variations, economical conditions, and local events, in order to better predict the demand trends and future rates. Last but not least is to pay more attention on forecasting accuracy, as it can increase revenue up to 2%.